In trade war with the US, China holds a lot more cards than Trump may think. In fact, it might have a winning hand. China was the one major exception to Donald Trump's plan to impose prohibitive tariffs on all of his trading partners, while the rest of the world would be given a 90-day reprieve on additional duties. Beyond the new 10% tariffs on all U.S. trade partners, China would feel the squeeze even more. Trump increased the tariff on Chinese goods to 125% on April 9, 2025. According to Trump, Beijing's lack of respect for global markets was the impetus for the move, but the U.S. president may well have been smarting from Beijing's apparent willingness to confront U.S. tariffs head-on. Beijing took a different approach than many other nations, preferring negotiation and dialogue over retaliation for Trump's delayed reciprocal tariff hikes. It responded with swift and firm countermeasures. China raised its own tariff on the United States to 125% on April 11, calling Trump's actions a joke. The two economies are now locked in an all-out, high-intensity trade standoff. Furthermore, China shows no signs of resigning. And as an expert on U.S.-China relations, I wouldn't expect China to. China now has a lot more leverage than it did during Trump's first term, when Beijing eagerly sought to negotiate with the United States. In fact, Beijing is of the opinion that it can strengthen its global position while simultaneously causing the United States at least as much harm as it does. China's new calculations: the export-oriented manufacturers in China, particularly those in the coastal regions that produce furniture, clothing, toys, and home appliances for American consumers, are certain to suffer greatly from tariffs. But since Trump first launched a tariff increase on China in 2018, a number of underlying economic factors have significantly shifted Beijing's calculus. Crucially, the importance of the U.S. market to China's export-driven economy has declined significantly. At the beginning of the first trade war in 2018, 19.8% of China's exports went to the United States. In 2023, that figure had fallen to 12.8%. The tariffs may further prompt China to accelerate its domestic demand expansion strategy, unleashing the spending power of its consumers and strengthening its domestic economy. Even though China was in a period of strong economic growth when it entered the trade war in 2018, the current situation is quite different. The Chinese economy has entered a period of persistent slowdown as a result of sluggish real estate markets, capital flight, and Western decoupling. Perhaps counterintuitively, this prolonged downturn may have made the Chinese economy more resilient to shocks. Even before the impact of Trump's tariffs, it has forced businesses and policymakers to consider the harsh economic realities that are currently in place. Beijing may be able to use Trump's tariff policy against China as a useful external scapegoat to mobilize public support and shift blame for the economic slowdown onto American aggression. China also understands that the U.S. cannot easily replace its dependency on Chinese goods, particularly through its supply chains. While direct U.S. imports from China have decreased, many goods now imported from third countries still rely on Chinese-made components or raw materials. By 2022, the U.S. relied on China for 532 key product categories, nearly 4 times the level in 2000, while China's reliance on U.S. products was cut by half in the same period. A related calculation of public opinion is that rising tariffs are expected to raise prices, which could cause discontent among American consumers, particularly voters from the blue-collar class. Indeed, Beijing believes Trump's tariffs risk pushing the previously strong U.S. economy toward a recession. Alongside the changed economic environments, China also holds a number of strategic tools for retaliation against the U.S. It supplies approximately 72% of U.S. rare earth imports, according to some estimates, and it dominates the global rare earth supply chain, which is essential to the military and high-tech industries. On March 4, China placed 15 American entities on its export control list, followed by another 12 on April 9. Many of them were high-tech companies or defense contractors from the United States, whose products needed rare earth elements. China also retains the ability to target key U.S. agricultural export sectors such as poultry and soybeans. Industries heavily dependent on Chinese demand and concentrated in Republican-leaning states. China accounts for about half of U.S. soybean exports and nearly 10% of American poultry exports. On March 4, Beijing revoked import approvals for 3 major U.S. soybean exporters. And on the tech side, many U.S. companies such as Apple and Tesla remain deeply tied to Chinese manufacturing. Tariffs threaten to shrink their profit margins significantly, something Beijing believes can be used as a source of leverage against the Trump administration. According to reports, Beijing intends to respond by putting regulatory pressure on American businesses with operations in China. Meanwhile, Beijing may attempt to divide the Trump administration by exploiting Elon Musk's significant business interests in China. A senior Trump insider who has clashed with U.S. trade advisor Peter Navarro regarding tariffs. Beijing is confident that it will be able to withstand Trump's sweeping tariffs on a bilateral basis. But it also believes that the United States' broadside against its own trading partners has provided a strategic opportunity for a generation to challenge American dominance. Close to home, this shift could significantly reshape the geopolitical landscape of East Asia. China, Japan, and South Korea held their first economic dialogue in 5 years on March 30th, and pledged to advance a trilateral free trade agreement after Trump had first raised tariffs on Beijing. The move was particularly remarkable given how carefully the U.S. had worked to cultivate its Japanese and South Korean allies during the Biden administration. As part of its strategy to counter Chinese regional influence, from Beijing's perspective, Trump's actions offer an opportunity to directly erode U.S. sway in the Indo-Pacific. Similarly, Trump's steep tariffs on Southeast Asian countries, which were also a major strategic regional priority during the Biden administration, may push those nations closer to China. Chinese state media announced on April 11 that President Xi Jinping will pay state visits to Vietnam, Malaysia and Cambodia from April 14 to 18, aiming to deepen all-round cooperation with neighboring countries. Notably, all 3 Southeast Asian nations were targeted with now paused reciprocal tariffs by the Trump administration: 49% on Cambodian goods, 46% on Vietnamese exports and 24% on products from Malaysia. A strategic opportunity that looks even more promising is further away from China. China and officials from the European Union have already started to think about strengthening their own trade ties, which could weaken the transatlantic alliance that had been trying to separate from China. During a phone call that took place on April 8, the president of the European Commission spoke with the premier of China. During the call, the two sides condemned the trade protectionism practiced by the United States and called for free and open trade. Coincidentally, on April 9, the day China raised tariffs on U.S. goods to 84%, the EU also announced its first wave of retaliatory measures, imposing a 25% tariff on selected U.S. imports worth over $20 billion, but delayed implementation following Trump's 90-day pause. Now, EU and Chinese officials are holding talks over existing trade barriers and considering a full-fledged summit in China in July. Lastly, China sees a potential threat to the international standing of the US dollar. In Trump's tariff policy, widespread tariffs imposed on multiple countries have shaken investor confidence in the U.S. economy, contributing to a decline in the dollar's value. Traditionally, the United States dollar and the status of Treasury bonds as safe haven assets has been questioned by recent market turmoil. At the same time, hefty tariffs have undermined trust in the dollar and the United States, causing concerns about the economy's health and debt sustainability. Treasuries, while a portion of the Chinese economy will undoubtedly be impacted by Trump's tariffs, Beijing appears to have significantly more options this time around. It has the tools to harm U.S. interests in a significant way, and perhaps even more importantly, Trump's unrelenting tariff war is offering China a unique and unprecedented strategic opportunity.